Hello, my name is Matthew Rivera. I would first off like to thank Mr. Schleicher for the Lubbock Youth Tennis Center for allowing me to come here and talk about tax-wise charitable giving. Today I will be discussing retirement plan gifts. A charitable retirement plan gift is a contribution from a qualified plan or IRA to a charity, typically upon the donor's death. It has been gaining much popularity because individuals have been building larger qualified retirement plan balances, mostly through 401k plans. This is relatively new, but through various internet sources and through press releases, this is starting to gain popularity. The most important factor is individuals are now starting to realize after-death retirement accounts are junk assets. They are seen as tax heavy. Upon death, IRA assets or qualified plans may be subject to both income and estate taxes. People are realizing how little their intended beneficiaries will actually benefit from these plans, thus them giving these assets to charitable organizations such as the Lubbock Youth Tennis Center. Later on in this presentation, I'll give a simple example of how this takes place, showing the amount of taxes that will be taken out and what is actually left to the heirs. A charitable retirement plan gift is a good idea if you have a need to reduce overall taxes, estate taxes. If you have charitable intent toward a specific charity, such as the Lubbock Youth Tennis Center, or when you realize the tax-heavy nature of such plans. Next, we will be talking about advantages. Some advantages would be the excellent tax planning opportunities it provides. Clients with large qualified plan balances who leave those assets to charity upon death can avoid both estate and income taxes, otherwise due on these assets. It also removes most of the time delay, red tape, and costs associated with probate. For example, if you were to donate to the Lubbock Youth Tennis Center, they would receive that inheritance more quickly and cost effectively than if the gift had been made from the probate estate. This will not only help the organization, but in this case, the children as well. It provides the charity to receive a cash gift upon the donor's death. So instead of receiving something like real estate, the charity receives a liquid asset, and it prevents a result of having their heirs receive only a fraction of the plan assets after taxes. Once again, later on I'll be showing an example, this case in point. As far as disadvantages are concerned, some disadvantages are the direct gift of a retirement plan may result in the surviving spouse lacking necessary retirement funds. So in this case, you just have to plan accordingly with your financial planner. These types of plans are revocable, so the charity has no guarantee the gift will be made, and unless the donor employs a wealth replacement, heirs may lose part of their perceived inheritance. Now moving on to requirements. The requirements are as followed. The plan participant must obtain a change of beneficiary form from the pension plan administrator or IRA custodian, naming the charity as the beneficiary. So for example, if you would like to donate to the Lubbock Youth Tennis Center, all you have to do is get one of these forms and change the beneficiary name, naming this charity as a beneficiary. Easy as that. Requirement number 2. In the case of a qualified plan, the plan participant's spouse must also sign off on this change. This is mainly because, like we said, after the participant dies, the spouse will get the remaining. So if we're switching it over to the charity, they have to be aware of this. Number 3. The beneficiary designation is revocable. The participant maintains total control and can change beneficiaries at any time during their lifetime. Number 4. The participant or IRA owner generally must begin taking required minimum distributions shortly after age 70 and a half. Later on, I'll go in more in depth on the required minimum distributions. Number 5. For purpose of the minimum distribution requirements, after the participant's death, a charitable organization will not qualify as a designated beneficiary. And lastly, number 6, the donor is not required to file any type of gift tax return. Okay, now as you can see on the screen, here's a simple example of what would happen if you do not use charitable planning. Okay, in this example, we're going to assume that we have a couple, both age 60, and have 2 adult children and the following assets. As you can see, this couple has a personal residence valued at $500,000. Their vacation home is valued at $250,000. They have a CD valued at $600,000, and the wife's IRA has accumulated $2.5 million. Total assets will equal $3.85 million. Also for this example, we're going to assume that the husband is the beneficiary, meaning if the wife dies before him, he will inherit all the assets. Okay, now that we have all the assets in place, we're going to assume that both the husband and the spouse have passed away, and the rest of the assets are going to be passed down to their children. As you can see on the screen, federal estate taxes on just the IRA alone would be $1.25 million. And I got this by multiplying the IRA amount of $2.5 million times 45%. As far as the income tax due on just the IRA, it would be $481,250. This is found by the IRA amount, once again, of $2.5 million, subtracted by the federal estate taxes, and then multiplying it by their marginal tax rate, which is 35%. When both are paid, only $893,750 is left from the $2.5 million IRA for their children. So going back to what I previously said earlier about the amount of taxes that will be taken away from an IRA account, you can see how this comes into play now. They lose a large portion of that IRA account. A lot of people are not comfortable doing this because they work their whole life to build up this IRA account to leave to either their spouse or to their children, and just to have all these taxes taken out could be a heavy burden on them. So a lot of people are, with this new knowledge, are starting to go into tax planning with financial advisors and seeing their options so they could try to minimize that amount of taxes that are going to be taken out. Okay, moving on. There are 2 potential charitable planning alternatives for the IRA proceeds. At this time, due to time constraints, I will only be talking about one. This option is called the testamentary gift directly to charity. The wife can name her favorite charity or several charities as a primary beneficiary of the IRA. This technique would provide a direct gift to the charity upon her death, without the retirement plan assets being subject to income tax or going through the probate process, which we've talked about as being lengthy and expensive. Not expensive, but you could see the amount of taxes that will be taken out. She could also name her husband as primary beneficiary if she does not want to name a charity. This technique will minimize the taxes on the IRA proceeds. Okay, if you would recall earlier, I was talking about the required minimum distribution. As far as the minimum distribution is concerned, as you can see on the screen, the following are the requirements. In order to obtain the tax favored treatment that allows account balances to grow tax deferred during the participant's working life, qualified retirement plans, IRAs, and tax-sheltered annuities must meet certain distribution requirements set forth in the Internal Revenue Code. Generally, minimum annual distributions must be made beginning no later than April 1st of the year after the participant ages 70 and a half. There's actually 7 requirements to this, and requirement number 6 has 3 subsections. Requirement number 1 for the minimum distribution. Minimum annual distribution generally must begin no later than April 1st of the year after the participant reaches age 70 and a half. This is referred to the individual's required beginning date. Requirement number 2. The distribution required each year is determined by dividing the participant's account balance as of December 31st of the preceding year by the participant's life expectancy, taken from the Uniform Lifetime Table. And later on I'll be showing a very, very simple example showing this little formula, how it's put into use. Requirement number 3. If a participant has a spouse beneficiary who is more than 10 years younger than the participant, a joint and survivor life expectancy may be used, which results in lower distribution amounts than those derived. And once again, these tables are found on the internet, usually under the IRS.org. You can find all this information, but we don't need to go into that right now. Requirement number 4. Except for the rule for a younger spouse, the age and status of the beneficiary do not affect the amount of a participant's lifetime distribution in any way, nor do lifetime changes to the beneficiary designation. Requirement number 5. The determination of the existence and identity of the designated beneficiary will generally be made as of September 30th of the year after the participant's death. Consequently, if an individual or entity was named as a beneficiary at the time of death, but is no longer named as of September 30th of the following year, he will not be considered in determining the requirements after death distribution. And once again, there's tables showing all the amount of, usually these tables show the age of employee, the distribution periods. So all of this really matters because depending on the age and depending on the spouse's age is how you could determine the number of years for distribution and ultimately the amount required for distribution, for the minimum distribution. Number 6, the requirement number 6. Distributions after the death of a participant depend on whether he dies before or after his required beginning date. If the participant dies before his required beginning date, one of 2 methods must be used: the life expectancy rule or the 5-year rule. And for this discussion presentation, I will only be discussing the life expectancy rule. So for number 6, subsection A, the life expectancy rule applies if any portion of the account is payable to or for the benefit of an individual beneficiary. If the individual is a non-spouse beneficiary, distributions generally must begin by December 31st of the year after the participant's death and be made over the individual's single life expectancy. Subsection B. The life expectancy rule is more lenient if the sole beneficiary is a participant's surviving spouse. Distributions are not required to begin until the later of December 31st of the year after the participant's death or the end of the calendar year in which the participant would have reached age 70 and a half. And finally, requirement number 7, the regulations state that an entity other than the individual or a trust meeting special requirements may not be designated beneficiary for purposes of meeting the minimum distribution requirements. And a special note, the penalty for failure to make minimum distributions is 50% of the amount involved and is imposed against the participant, not the plan. So that's something to keep in mind. Okay, and like I said, for a very simple example, very straightforward, is an example of planning opportunity. For this example, we're going to assume a husband just reached 70 and a half and has an account balance of $3 million. As you can see the formula before, we have an account balance divided by life expectancy equals required distribution. So in this case, it'd be 3 million divided by 27.4 years, which we found in the table, which gives the required distribution $109,489. In conclusion, As you can see, using a charitable retirement plan gift is very beneficial. It will not only help out your heirs, but will eventually go to a good cause such as the Lubbock Youth Tennis Center. Places like this bank on charitable gifts to help the youth, so it is a great thing all around. I would once again like to thank the Lubbock Youth Tennis Center for allowing me to speak today. I left my business card with Mr. Schleicher at the front desk if anybody would like to further discuss this or any other charitable giving options. Once again, thank you for your time, and have a great day.